But we're moving on to our next speaker this morning, and the session is going to be titled the overall session is titled Future Farms: Unlocking Productivity Through Innovation. And to share her thoughts on technology and innovative practices reshaping Australian agriculture, I'm delighted to introduce Andrea Willis. Now, Andrea joined ABARES in December 2024 and is responsible for the Farm Performance and Information branch that covers agricultural productivity analysis, the Farm Surveys programme, climate change and farm profitability, and social sciences. She's also held senior positions in the behavioural economics team of the Australian Government, in the Department of the Prime Minister and Cabinet as Managing Director. Please welcome Andrea.
Good morning, everyone. When we talk about productivity, we're really talking about how well agriculture turns effort into outcomes, how much we get out for what we put in. And that matters because over time, productivity is what underpins farm profitability, resilience to shocks, and the ability of our farms to stay competitive in a changing climate. This morning, I'll set the scene for our panel discussion. I'll take you through the greatest hits of data insights from ABARES' productivity team. And I'll finish by looking ahead, where some of the opportunities are, why the gap between leading and average performance matters, and what this means for innovation and research and development. Yesterday, a number of presentations and discussions mentioned productivity. It's a pretty hot topic right now. Before I dive into some of our analysis, I'll take a moment to explain what we mean when we talk about productivity and how we measure it. Productivity is about efficiency. It's an economic measure of how much output we get from a certain volume of inputs. You can see here the types of inputs and outputs that we include in our analysis. Labour, land, capital, materials, and contracted services are all used to produce outputs like crops and livestock. So if productivity is a measure of inputs and outputs, then in order to get productivity growth, we need to use fewer inputs to produce the same amount of outputs, or more output needs to be generated with the same amount of inputs, or a combination of both. There's a strong relationship between profitability and productivity. Two factors have a direct bearing on the economic viability of farms. One is prices, the prices that farmers receive for their goods, and the prices they pay for inputs to make those goods. The other is productivity. Most farmers have little control over prices, but they do have more control over things that affect productivity, like farming practices, innovation, and decisions about what to grow and when. Boosting productivity helps farmers stay profitable, competitive, and resilient. It also supports farmers to adapt to challenges like changing trade conditions, climate variability, and shifts to the terms of trade. So let's take a look at how productivity has been tracking within Australian agriculture over the long term. Well, the answer, as you can see here, is pretty good. Productivity growth has been strong and consistent in the broadacre industries at about 1% per year on average since the late 70s. Within industries, though, there has been significant variation. Cropping stands out as a particularly strong performer with growth of 1.6% per year on average, with growth in livestock industries a little slower. When we look closely at productivity growth, such as within the dairy industry, the story becomes a bit more complex. In the chart you can see here, we've calculated productivity growth for different dairy regions across Australia, with stronger productivity growth shown in the darker shade of blue. What's interesting here is that there's differentiation in the productivity growth rate across regions, including some regions that are geographically quite close to one another with similar climate and production constraints. This analysis shows how national averages can blur important regional and structural differences. We can see here that productivity growth in Australian agriculture has slowed recently. Since around 2000, productivity growth in broadacre agriculture has been about 1/3 of what it was in the decades beforehand. It's worth pointing out, though, as we've already heard, that agriculture's productivity performance is still much stronger than the rest of the Australian economy. Most earlier gains from mechanisation, technological adaptation, and resource reallocation have already been captured. The slowdown here reflects multiple factors, including those related to industry, climate, adaptation, and farm size. You can see that the productivity slowdown hasn't been consistent across industries. The chart here shows industry growth rates in the slowdown period only, from about 2000 onwards. Compared to the longer-term growth rates that I shared earlier, average annual growth rates for a number of industries are either flat or in the red. Cropping is again a standout performer here. It's an industry that has benefited significantly from scale and mechanisation by adopting technology and replacing labour with capital. Livestock, on the other hand, has slowed or in some cases gone backwards. Livestock farming remains labour intensive despite significant advancement in other innovation pathways like genetics. These kinds of differences contribute to the variation that we see in productivity growth rates across industries. We know that there's a clear relationship between farm size and productivity performance. You can see in the chart here that the larger farms have faster productivity growth. They're also the ones that have the most access to capital, the most capacity to take on risk, the most capacity to benefit from economies of scale, and are most likely to benefit from adopting new innovations. These are all key drivers for greater productivity growth. And we can see this dynamic at play when we drill down into the data underlying our productivity statistics. Productivity growth has been driven, in part, by shifting resources to more efficient farms, but these gains have been now largely realised and structural change has slowed. Consolidation in sectors like dairy has already led to fewer but larger farms. One factor that we know impacts productivity growth is climate. At ABARES, we've done some work to try and untangle the effect of climate from our underlying productivity calculations. The orange line in this chart shows productivity in the cropping industry. You can see some of the significant dips in the chart where drought and poor conditions are having an impact. The blue line shows what happens to productivity when we adjust for climate and impose long-run average climate conditions. The gap between these two lines shows the impact that climate is having on productivity growth, demonstrating that productivity growth would have been higher under long-run average climate conditions. Clearly, climate variability has made it harder for many farmers and dragged down industry productivity growth. Despite this, growth has continued, even when accounting for these climate impacts. It's clear that building resilience and adopting climate-ready technologies remain central to future productivity gains. Often when we talk about productivity, we're talking about the average productivity growth rate of an industry, but what sits below that average can vary. The frontier represents the highest level of productivity achievable with the resources available, essentially representing what we call best practice. Productivity growth occurs when the frontier shifts, indicating improvements in best practice. Comparing the industry average to the frontier is helpful to show the inefficiency, or what's lost from not having every single farm operating at the maximum productivity they would if they were sitting at that frontier. You might remember this chart yesterday from Jared's presentation. Here you can see that the frontier and average productivity rose together during that early period of rapid productivity growth. This was driven by both advances in best practice and also wider adoption of efficient methods. In recent years, though, it's evident that progress at the frontier has decelerated, and there have been times where the average farm performance has fallen well short of best practice. Now, it's not going to be the case that every farm can be at the cutting edge, and nor is it reasonable for us to expect that. But when it comes to lifting productivity, and if we want to return to the same rates of productivity growth that we experienced previously, we need to be thinking about the things that drive best practice and the way that farms adopt best practice collectively. One of the drivers of productivity is research and development. R&D provides new ways to do things, new products, new processes, and new best practices for farms to adopt. We've previously analysed the impact of R&D on output, finding that for every dollar invested in R&D, the return is about $8 over a 10-year period. We've also estimated that about $3 billion was provided for R&D funding in 24-25 from government, the private sector, and universities combined. But growth in R&D funding has slowed and in fact has gone backwards on average over recent years. Some of the previous periods of strong productivity growth have been enabled by great R&D, and that's delivered gains for farmers and the broader economy alike. This history tells us that productivity growth depends on continued and well-targeted innovation investment, including extension services to help it reach more farms. While R&D provides opportunities for advancing productivity, there are barriers that can hinder innovation and growth. Some are common to all industries, and others are experienced more in agriculture. Survey data from the Australian Bureau of Statistics shows that agricultural businesses face similar challenges as other sectors when it comes to finding skilled workers and securing funds for innovation. However, agricultural businesses are about twice as likely as other businesses to call out government regulation and compliance requirements as barriers to innovation. In addition, the costs of developing and implementing new practices and technologies are felt by ag businesses more than other sectors. Tackling these pain points could make a difference and help the sector unlock further productivity gains. So before I pass over to the panel, a quick recap. Innovation is crucial for increasing productivity, but it requires effective adoption on farm. Key enablers will include investing in building resilience to protect gains already made and enable growth into the future, particularly in the face of a changing climate. Maintaining R&D efforts and accelerating adoption of new practices will help speed up those returns on that R&D investment. And of course, there are other drivers, some of which were raised in the discussions yesterday, like regulatory reform, ensuring competitive markets, and supporting an environment where resources are effectively allocated and used by the farms most able to make the best use of them. And finally, addressing and reducing some of those barriers, particularly those that are unique to ag, will help enable change and support productivity growth. I'm looking forward to hearing the panel's insights on this and their views on how we can reignite productivity growth for agriculture. Thanks, everyone.